Hey everyone, welcome. I'm Phil Hodgen, and welcome to the very last Hodgen Law PC International Tax Lunch of calendar year of our Lord 2023. We do this almost every month on the last Friday of the month at noon Pacific time. This month, we're a week early because the last Friday it collides with Thanksgiving, and we're going to skip December because that collides with Christmas. So next time we get together will be the end of January. You can listen in online to what you're doing now, or later we'll get it recorded and we'll get the recording and post it up on YouTube, and you can watch it then. This month's topic is foreign tax credits, as you can see from the slide. Controlled foreign corporations, they're corporations, they do business. Frequently, they're in countries that have income tax and they pay tax. How can you take advantage of that tax paid at the CFC level to offset U.S. tax liability for the U.S. shareholder? So we're going to talk about foreign tax credit today. And this is the last in the series of the sort of hyper-technical stuff. The last three episodes, January, February, and March, are going to be more the care and enjoyment and feeding of your CFC. Reorgs we're going to do first, and then we'll do use and abuse of Section 962, and then we finally end up with comparing CFCs versus other kind of structures for tax efficiency, which will be in March. So that's what you have to look forward to. So if you have a question, Rachel's going to post a link to a Zoom Q&A that will run for about 30 minutes after this session. So just grab that link and log into the Zoom room, and I will answer questions until I absolutely need coffee. Then I'll walk up the street to the Boy and the Bear and get a cup of coffee, because it's Friday afternoon. Anyway, let's get started with a foreign tax credit. Here we are again, and just showing what's coming up next. We're in the damage control part of the series. Foreign tax credit being a way that you have damage control. You've got this deemed income, subpart F income, or global intangible low taxable income that hits your income tax return. So how can you avoid some of the pain? And the answer is by trying to claim the foreign tax credit if you can. And you can see the other sessions coming up. Table of contents, what we're going to talk about today. This is mostly for your use later in case it's useful. So let's get started with our friend, the introduction. So let's start really basic. There are two kinds of foreign tax credits that we'll be talking about today. There's what I and everybody else calls the direct foreign tax credit. It says you were the one that are out of pocket for paying the foreign income tax, and therefore you are allowed to claim the foreign tax credit. The deemed paid foreign tax credit, sometimes called the indirect foreign tax credit, is where somebody else has paid the tax, but through magic and the Internal Revenue Code, you are allowed to claim a foreign tax credit even though you didn't write the check to the foreign government. So deemed paid is the language they use in the code. Indirect is what a lot of people call it, but I'm going to try and stick as much as I can to using deemed paid. So this, in our context, means there is a U.S. shareholder of a controlled foreign corporation. The controlled foreign corporation pays corporate income tax somewhere, and therefore that tax paid by the controlled foreign corporation, we pretend, was actually paid by the U.S. shareholder, and therefore the U.S. shareholder can claim a foreign tax credit on its income tax return. So here's a little picture of what we know and love, the direct foreign tax credit, just a simple example. Dividend income comes upstream from the CFC. There might be withholding at source on the dividend income, Alternatively, you might have an American living abroad owning a real operating business inside a corporation. It pays a dividend, and that American shareholder abroad pays personal income tax on the dividend income received. Either way. And the rules, which is, I give you the citations up there, section 901 and 904, basically say, the red arrow out, that individual shareholder has paid some actual cash money tax to a foreign country. And the blue arrow back says the Internal Revenue Code gives you a credit for the foreign tax paid elsewhere to offset the U.S. tax liability on that dividend income. So that's the concept. This is something we know and love. There's, your limit is, as we'll see in a few minutes, the maximum credit allowable is the smaller of your U.S. tax liability or the foreign tax you actually really truly paid. There are all sorts of wrinkles, like if there's a tax treaty between the United States and the country that's doing the withholding, you have to claim the tax credit at the treaty rate rather than whatever the actual amount withheld is. And if you have over withholding, that's a problem that you deal with the foreign country. Stuff like that. I'm not going to spend time here because most of us live here, and I'm going to spend most of my time on the deemed paid tax credit. I mean, really, this foreign tax credit thing is, an hour. Well, there are 3 separate standalone portfolios in the BNA portfolios just on foreign tax credit. So how can we possibly cover everything in an hour? I don't know. I'm trying to figure out a way to do this when I recycle this series next time. I'm not going to do it on CalCPA because I'm going to give new topics for next year starting in April, but I'll recycle this and repurpose it, somewhere on the side so it'll be available and better next time. Now, indirect foreign tax credit is a lot more complicated, a lot more moving parts. So we have a very, very simple example. Foreign corporation is the CFC, 100% owned by a U.S. parent corporation. It's a C corporation. And the human being above is just for completeness. We're not going to talk about the human at the very top of the food chain. But the foreign subsidiary pays its normal corporate income tax in the foreign country where it operates. And Section 960 says there is a deemed paid foreign tax credit, and it has a bunch of rules for how you calculate it. And you take that number that the U.S. parent corporation is pretended to have paid, and then that's applied on Form 1118 to the corporate income tax liability of the parent corporation. And the reason that this happens is because of that little arrow on the left, because we have either subpart F, gross income inclusion, or we have global intangible low taxed income inclusions. And so fair is fair. If you're going to get the income, you should get the benefit of the foreign tax credit on that income. So that's the game. And looking at this, it struck me that the Internal Revenue Code is really the geocentric astronomical method. The universe revolves around the Earth, the Ptolemaic theory. And come, 1500s, whatever it was, when Copernicus wrote his thing and said, no, actually, the Earth is not the center of the universe. The Earth revolves around the sun. But the whole point of that is that the old system of describing how the universe worked involved the Earth at the center and the planets and the stars moving around. And planets didn't behave as they should have. And so the whole system had cycles, epicycles, and deference. So, it's because Mercury and retrograde and all of that. And if you start to look at the Internal Revenue Code through the eyes of astronomy and ancient history, you see that you have some very basic principles in place, but they don't quite map to reality. And so we start to get these little weird things and exceptions and special rules and this and that. And all I can tell you is this all comes from the worldwide system of taxation that we have. Sooner or later, it must crumble, just as the ancient you know, concept that the universe is centered on the earth, which had useful connotations for theological reasons. That too will change, but it's not going to change in our lifetime. So we just cheerfully suffer along with all the BS that's in the Internal Revenue Code. And as you'll see with this discussion of the foreign tax credit, there are a couple of very basic principles in place. And then everything else happens in the limitations and but yes and stuff like that. So let's look at those basic rules. These are the operating rules. And once you get the concept of how the pieces are bolted together, then you can start to look at the exceptions and the overlays and the things that we're going to, the taxpayers found an exploit and used it, and another patch was thrown on top. That's what's happened. So Mercury is in retrograde, and the ancient astronomers couldn't explain it. So they said epicycles. Same thing. Let's start at the very beginning. Internal Revenue Code 27. It's important because it's under, the number is 27, so low, under 100. This is where all the important stuff is. Your tax rate, the definition of taxable income, all of that. Anyway, Section 27, simple sentence. The amount of taxes imposed by foreign countries and possessions of the United States shall be allowed as a credit against the tax imposed by this chapter to the extent provided in Section 901. So, important thing that you should note there, imposed by this chapter, that phrase, that refers to Chapter 1 of Subtitle A of the Internal Revenue Code, Title 26. And Chapter 1 of the Internal Revenue Code is the income tax. And that right there is why a foreign tax credit will not apply to offset the tax liability from the net investment income tax, because the net investment income tax is in Chapter 2A of subpart of Subtitle A. So that's why. And now, related to that, I think a couple episodes ago in my newsletter, I talked about a very recent case, like September or October of 2023, in the United States Court of Claims, Christensen with a SEN versus United States. And these were Americans living in France, and they claimed foreign tax credit using the France-USA income tax treaty to say, no, in fact, we get to use the treaty to offset our net investment income tax liability for U.S. income tax purposes. Government said no. The judge in the Court of Claims said, yes, in fact, you do get that. And so my admonition to you is that if you have American citizens living abroad, remember the net investment income tax only applies to humans, right, basically. And so we're going to be talking about parent subsidiary structures, but there's just an important aside that if you have Americans living abroad and there is a treaty between the United States and that country, you might want to look at the Christensen versus United States opinion. It's 92 pages long. It's like 48,000 words. But there may be a possibility that it will give you the ability to claim the foreign tax credit to offset net investment income tax liability. Certainly, if you have American citizens living in France, it's going to work because the courts have said so. Government may not like it, but that's the rule for now. Anyway, Christensen with a SEN versus Commissioner, Google it. September or October 2023 is when they published the opinion, and you'll find it and read it. There's a quiz next Friday. All right, so that's the basic implementation. Now, you notice, to the extent provided in Section 901. So this is Congress's word for, here's the big idea. We're going to delegate the job of the details off to somebody else in Section 901. So we go to Section 901, and then Congress says, oops, we delegated to Section 901, but we write Section 901, so we delegated the job to ourselves. So let's get to it. And they write the basic rule of Section 901, which is where people normally start, and I certainly do. We ignore Section 27. And it says that a taxpayer can elect to take a credit, and the amount of the credit is the amount of tax you paid. That's the highlight subsection B, or the amount deemed to have been paid under Section 960. So this is the basic implementation. But again, you're going to see in there on the second line, subject to the limitation of Section 904. So just like a lot of things in tax law, you go from one code section to the next, to the next, to the next, until you finally come to the end of the line and you have your answer. So Section 901B says you are allowed a credit equal to the tax paid, unless Section 904 overrides that. Go figure, Section 904 is going to override it. So there's the limitation saying all of this other stuff that's not highlighted is true unless Section 904 says something different. And wouldn't you know it, it says something different. So Section 904 says don't get me started on how people write laws. This basically says the limit on the maximum amount of foreign tax credit you can take is the amount of U.S. income tax on that income item. So they don't want to give you more foreign tax credit than the tax that the U.S. would have imposed anyway on this particular income item, a dividend, for instance, because otherwise you could pay a lot of income tax in another country, France, for instance, and bring all of that foreign tax credit home to the United States and use it to offset your French source income and offset your tax liability for U.S. source income too. And they don't want that to happen. So you see there are two limits here. Section 901 says the max you can take is the tax you actually paid. Section 904 says the max you can take is the U.S. tax liability on that income item. And so it's the lower of the two is your rule. That's the tax credit that you'll be able to take. So with those basic concepts in mind, let's move on to Section 960, which is the enabling legislation that tells a U.S. shareholder of a controlled foreign corporation how to claim a foreign tax credit on corporate income tax paid by that CFC. So just for cross-reference again, remember Section 901 said you can take a foreign tax credit for the taxes you actually paid, which is 904B, 901B, subsection B in this thing, or the taxes deemed to have been paid under Section 960. So this is the connecting tissue between Section 901, which gives you the ability to elect foreign tax credit, and Section 960, which tells you how much you are deemed to have paid of that CFC's corporate income tax paid to the foreign country. And this is what Section 960 says. It says, important point, it has to be a domestic corporation. So if subpart F income, Section 951A1, has been included in the gross income of a domestic corporation, then the U.S. shareholder, the domestic corporation, we pretend that it paid its pro rata share of the foreign corporation's income tax. So, and, so much as is properly attributable, and that's English words for math problem. There's a similar provision, and this is Section 960D, like David, for global intangible low-taxed income. And the same thing. If there is global intangible low-taxed income included in the gross income of a domestic corporation because of Internal Revenue Code Section 951 Cap A, then the U.S. shareholder domestic corporation is deemed to have paid 80%. So there's a haircut in here of And I've just put math problem in there, and this is how to calculate the corporate income taxes actually paid by the CFC that flow upstream and are allocable to the global intangible low taxed income. So the point of this slide is not so much the math problem as conceptually that there is a flow through that if you have this inclusion, then you get to elect a foreign tax credit. And now the only question is how much of the CFC's corporate income tax is the U.S. shareholder deemed to have paid, and you calculate a raw number, then you take 80% of that, and that's the max that you're deemed to have paid. So you paid 100 euros of corporate income tax. The max you are taking over to Section 901 and 904 to figure out the limitations is 80 euros. Finally, and this is applicable here for the foreign tax credit stuff, but also generally for understanding how the Internal Revenue Code is put together, because they have these cross references all the time, except as otherwise provided in this subpart, and for purposes of Chapter 1. So in our case, for foreign tax credit, we're doing that. And this is how you understand what these little phrases mean and what so what matters and what doesn't. So when we read these code sections for the foreign tax credit, and it says, for purposes of subpart A, what does that mean? And you can see the hierarchical structure of the Internal Revenue Code. So we start with the Internal Revenue Code itself, which is Title 26 of the United States Code. So the encyclopedia of all the laws of the United States are the United States Code, and there are 53 separate titles, and the tax laws are in Title 26. And then you can see how it's broken down into subtitle, chapters, subchapters, parts, subparts. Boom, 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 boom. And when you get to subparts, that's where you find the actual Internal Revenue Code section 901 or whatever. So if you ever get lost and you're trying to figure it out, I would say the best way to do this is go online and go find law.cornell.edu. So this is all the laws of the United States published online by Cornell Law School. And you find the tax code there. Easiest way. I have a subscription to BNA and Checkpoint, and I use Cornell online all the time instead because it's so much better. Just find your favorite code section. So the Google search would be 26 USC 901. Boom, you'll find it, and it'll be the first link on the search results. And you click on it, and then you go to the very top of the page, and you can see the hierarchical structure of how this is laid out and where your particular code section is within the whole hierarchy of the Internal Revenue Code. And also, if you want to find the Treasury regulations, the search is 26 CFR for Code of Federal Regulations, and then whatever, 1.901-1 or whatever you want, and you'll find it there too. Highly, highly, highly recommended. Anyway, so this is what that is. And, this is, remember I talked about the tax imposed by this chapter where the foreign tax credit applies to income tax but does not apply to net investment income tax. This is why, because the income tax rules are in Chapter 1, the net investment income tax rules are in Chapter 2, Cap A. Therefore, the tax imposed by this chapter is not the tax imposed by Chapter 2A or the Social Security tax or, the tax on excise taxes on this, that, and the other that the government has. All right, that's a little aside for tax law researchy stuff for the month, and let's move on. We're going to talk now for the rest of the time about the deemed paid foreign tax credit. So this is CFC paid the tax. The shareholder, the United States shareholder, is taking the credit. Section 960. Now, who can claim this indirect, the deemed paid foreign tax credit? The answer is one type of shareholder for reals, a domestic corporation, and that means a C corporation because S corporations are treated as partnerships for foreign tax credit purposes. check the box entity obviously is going to be treated like a corporation. So that is the taxpayer who is entitled to use Section 960 and claim the deemed paid foreign tax credit. However, we've got the let's pretend feature of the Internal Revenue Code going, and let's pretend that a human being is a domestic C corporation for purposes of the deemed paid foreign tax credit of Section 960, if that human being makes the Section 962 election. So I'm going to have a whole hour on the Section 962 election and the math thereof in February. And so we'll go through that. But to my mind, the ability to claim the foreign tax credit, the indirect foreign tax credit under Section 962 is its primary benefit, because it's going to completely or almost completely eliminate any income tax from the pass-through of subpart F income or global intangible low-taxed income. So remember, it's not that an individual is eligible for this, but an individual who makes the election is therefore make pretend domestic corporation for tax purposes on these income items, and that is the enabling part that allows ultimately this income tax liability to flow through to a Form 1040 instead of a Form 1120. And just for clarity's sake, holding it through a pass-through, a human being can still make the election. So that's just there for nota bene. Now, we have Section 960. We're about halfway through the 30 minutes. Just to remind, because I forgot at the top, we'll do questions not in this session because I can't think and talk and read the chat window at the same time. I just can't multitask. But instead, we'll have that 30-minute Zoom window. Rachel, I'm sure, has posted the link at this point, so you can open the Zoom window and we can have Q&A after this session here. Anyway, how it works. We have Section 960A, which describes how the deemed paid foreign tax credit works for subpart F income. And we have Section 960D, like David, which is how the deemed paid foreign tax credit works for global intangible low taxed income. I am picking, as I usually do, to give examples using subpart F income because it's simpler. There's less funny math going on with subpart F income than there is with global intangible low taxed income, because any example with global intangible low taxed income goes through that. How much is the includable income? How much is a net DTIR? And then you got the 80% and all of that. So the concepts work the same. The flow through works the same. The math is simpler here. And I'm all about the simple. So let's take a hyper simple situation. We've got a CFC, one shareholder, domestic C corporation, net income of $10,000. I'm going to specify that it's all dividend income. So hypothetically, publicly traded stock on which there was no tax withholding at source, but the corporation is going to pay some tax liability in its home country. And you can see I've just arbitrarily assumed 30%. And so 10,000 net income, foreign country corporate income tax paid 3,000. Subpart F income for the U.S. shareholder is therefore going to be $7,000 because the subpart F inclusion is net of deductible expenses and taxes. And so that's why we get down to 7,000. And that's the math for that 7,000 happens on worksheet A, which is part of the Form 5471 instructions. Current E&P, for what it's worth, is 7,000. Just I put that there because there's always a limitation on how much passes through based on E&P and all that stuff. So let's just take any kind of limitations off the table. First things first, we've got two things going on, right? We've got the income that is going to flow through to the U.S. shareholder, the domestic corporation. And we have the tax credit that's going to flow through for the domestic corporation to its Form 1120 on Schedule J, which is where the tax calculations are. And so first, let's put the subpart F income onto the Form 1120. And it shows up here on line 16C, the 7,000. I'm going to talk about this $3,000 of income on line 18 in a few minutes. This is the section 78 gross up that we have to go through if we're going to do the foreign tax credit. And you can see at the bottom, line 23, there's $10,000 of total income that's going to hit the front page of Form 1120, and we're going to calculate some income tax liability for the corporation based on that. So everything conceptually makes sense. Everything is in balance in the world, and yeah, there is fruit on the trees. So now let's talk about the look-through rules. We have a problem with the foreign tax credit is taxpayers abused it. So originally it started off, you get a tax credit for foreign taxes paid. The government soon finds out that people are taking a tax credit for income taxes paid in the UK and offsetting it against their US income tax liability on US income, say that's bad. So they ended up with a bunch of different buckets of or categories of income. And so that way you sort of mix and match and take unfair advantage of the foreign tax credit, unfair from Congress's point of view. So the very first thing that you're looking at on Form 1118 is this separate category thing. And so this is a situation where there are different categories of income earned by the CFC passed upstream for foreign tax credit purposes. And remember the Section 904 calculations and limitations. Those are applied category by category. And and sometimes it gets nerdier than that. But this is the basic rules. We're going to divide it up, and I will tell you about something that is happening that I didn't put on the slides because I wanted to simplify the example, but to give you another example of yet another exploit by the taxpayers that was shut down. High tax kick out, if you want to search through the instructions to Form 1118. So there are four, if you look at the foreign tax credit rules over the arc of time, there were a bunch, and then up until 2017, then they cut them way back, and there were only two, and then in 2017 we added two more. So at the moment we have four different categories of income that we have to divide the CFC income into for purposes of calculating the appropriate foreign tax credit limitation. So we have subpart F income. Which category should we use for the subpart F income? Well, we're not going to allocate the subpart F income to the category that's for global intangible low tax income, and because it's not that kind of income. Similarly, we are not going to allocate subpart F income to foreign branch income because a foreign branch is a domestic corporation that's doing business overseas. And here we have a foreign corporation which by definition isn't a domestic corporation, is it? So the only two categories that we can allocate subpart F income to on Form 1118 for the purpose of calculating the foreign tax credit limitations are these last two, the passive category income and the general category income. And the way that you do this is called the look-through rule, and it's in Section 904D, and we will look at that. But let's look first at the instructions to Form 1118. So you see here in the big red box, this is page 5 of the instructions. It says, it brings your attention to the look-through rules, and it tells you where to look in the code and the regulations to figure out what these things say. And in general, I am a big fan of the way that the tax forms are created and the instructions are written because they drop little cues in here. And reading this is enough. You say, I might have a problem here. I better go read the code and the regulations to figure out what I need to do. Because B&A wrote 3 books about this. So the instructions to Form 1118 are certainly not going to be that long. So they can't hope to cover everything completely in the instructions. So this is where you're looking, and this is your clue that you're going to say, oh, I have subpart F income. I have to look at these things called look-through rules and figure out how I'm going to allocate that subpart F income into the passive or the general category. There's some other little fiddly categories like discs and stuff like that. I don't care about that. There's shout out to Cameron Ware in Calgary for that. If you're on, Cameron, hi. He said, no, for God's sake, live in Pareto land. Don't tell me all the little esoteric details that don't apply to me. I'm just I'm a farmer out in the field with my crops. What do we have to solve 80% of the time? Let's talk about that. And he's exactly right. So let's talk about this look-through rule. At the basics, the idea is really simple. As usual, the wording is very cumbersome. But the basic thing is you look at the bucket of subpart F income and you allocate that bucket of subpart F income into income that looks passive, and income that isn't passive falls into the remainder, which is the general category. And it sounds like, oh my God, there's a big math problem. But as you'll see in a few slides, you've already done the work and it's going to be easy. So the reason for the extra slides is because I want you to start to focus on the code sections. And you see this phrase, passive category income. It's very easy when you read the code and the regulations to not pay attention to the words. Because in a slide or two, you're going to see a phrase called passive income. And passive income is not passive category income. So you have to just be careful on here. But here is the rule in the regulations that says you figure out what's passive and whatever's left over is going to be general category income. Passive. Now here we come into the definition of passive category income. Passive category income means passive income and specified passive category income. Well, good luck. Thank you for that. That means we have to chase some more rabbit trails down through the regs until we finally figure out what this means. Specified passive category income, again, means these esoteric little things where, maybe 1,000 taxpayers a year file some form reporting this kind of thing, and we don't care about that. And passive income, when it comes to subpart F, turns out to be pretty simple. Is the subpart F income in the foreign personal holding company income category? If yes, it's passive. If not, it's general. And so why I said, the look-through rule sounds like kind of complicated, but in fact, you're going to go through the math. You're going to prepare Schedule I on your Form 5471, and that line 1E, that's the passive category. So if you have a whole bunch of subpart F income, some of which is on line 1E, some of which are on the other lines, the only part that's passive is going to be the part on 1E. So in my example that we're working with here, remember we had the CFC had dividend income, classic foreign personal holding company income. The subpart F income amount was $7,000. We look at the subpart F income of $7,000. We follow it back to worksheet A in Form 5471 instructions. We find it's all personal holding company income that flowed through to line 1E. And therefore, we allocate it to the passive category income for purposes of Form 1118. So that's going to be that's the bucket that the income is going to be in. And then we will apply Section 901 and 904 to take the lower of actual tax paid versus U.S. income tax liability on that income. Just to give you an example, and this is straight from the regulations, an example of a CFC that has subpart F income of 100. And if you look back up through the Schedule I, you'll see that 15 of that is foreign personal holding company income, and 85 is foreign-based company sales income, different type of subpart F income that we don't have to care about what it is and why, but just sufficient to say that we look at this, we allocate the $15 of foreign personal holding company income to the passive category, and the remainder is allocated to the general category. So in fact, for this particular example, you would be attaching two Form 1118s, one of which would have 15 of income and pro rata share of the tax paid, and the other one would have $85 of income and the pro rata share of CFC level tax paid on that. And then you do your math for the limitation on how much tax credit is actually allowable. Now, this is the fun part for certain definitions of fun of the Section 960 deemed foreign tax credit, the gross up, Section 78. This comes down to a question of do you take a credit or deduction? And without the gross up, the Section 78 gross up, the foreign tax credit rules would give you both a deduction and a credit. And in fact, this is a problem that went all the way to the Supreme Court and was solved in a hacky way by the US Supreme Court in the 1960s, I think it was. And then Congress promptly solved the problem by passing Section 78 to make sure that you don't take both a deduction and a foreign tax credit. So let's move on. I got, my little handy dandy math. On the left-hand column is you do not have to elect to take the foreign tax credit. You could just claim the taxes paid as a deduction against net income, and that would result in the line that says parent corporation taxable income, which would be subpart F income, and that would be the inclusion for the parent corporation paying 21% tax for a net tax liability of $1,470. With the foreign tax credit, the column on the right, you make the election, or the U.S. shareholder makes the election. We start with the same net income, less taxes paid, because you have to allocate the taxes to the income, but we add back the amount of taxes paid with the Section 78 gross up to come to the correct taxable income, because $10,000 is the correct taxable income on which the $3,000 tax liability was imposed. The $3,000 tax liability was not imposed on a $7,000 taxable income amount. So we calculate the next to the bottom line, parent corporation income tax 21%, $2,100 of income tax liability for the U.S. shareholder domestic corporation. And that line that says less foreign tax credit, 2,100, that is the effect of arbitraging Section 901. You get the amount of tax you actually paid, 3,000, or 904. If lower, you get the tax credit of equal to the U.S. tax liability. And you end up with parent corporation as a net tax liability of zero. So Section 78 is designed to make it fair and square. You either take the credit or you take the deduction method for income tax. Too many words. So here's the language. So you gross up, you add back the amount of the taxes you're deemed to have been paid under Section 960, under the different rules. And so whatever the math tells you in Section 960, that's your add back under Section 78 as additional income. And I want to draw your attention, particularly, we're not talking about global intangible low taxed income, but we are talking about subpart F income. However, see that 80% number. If we were talking about global intangible low taxed income and the CFC had paid $3,000 of corporate income tax to the foreign country, the amount deemed paid for credit purposes would be 80% of that, so 2,400. But the amount of inclusion added back to income, you ignore the 80% thing, so you add back the full 3,000. So you're taking a little bit of a hit. The other important thing to look at is those bolded words as a dividend. So this gross up is called a dividend, but it sure doesn't behave like a dividend. And we'll see this in another section. And anyway, that was puzzling for me. And here's what you do with the gross up. So remember, we added back in my little example $3,000, which was the amount of tax deemed paid on the subpart F income. And what do? You don't treat it as a dividend on the U.S. shareholders form 1120. Instead, you just add it back into its more subpart F income. That's all that happens. So that makes it really simple. You start with 7,000 of subpart F income. You add 3,000 back, so you're up to $10,000 of subpart F income. And now you can do the calculations and the look-through rule on the entire $10,000 to figure out how much is passive and how much is general. And here's where it is. So rather than just giving you a line on, this is Schedule C of Form 1120. Rather than giving you a line, for the entire 10,000, they break out this for the subpart F income inclusion and the gross up on line 18 of 3,000, and that's how you get to the total dividends and inclusions. So line 18, it's called a dividend, but it doesn't behave like a dividend for foreign tax credit purposes, but here it is for income purposes. The Form 1118, just so you see where it goes, you'll see you put the subpart F income without the gross up and then with the gross up, and then the totals through at the very end on column 12 into the 10,000. So this is how the income tax return, the Form 1120, and the foreign tax credit form 1118 sort of mirror each other. And we know that we are working with the correct amount of income, because remember that Section 904 says, look at the income item for U.S. tax purposes and what is the correct amount of U.S. income tax on that. And that's why we have to take pains to make sure that we're starting with the correct amount of includable income for foreign tax credit purposes. Okay. Now, after you've done this, so you're in Section 960, the math is the math. For a deep dive session, we would go through the math, especially for the global intangible low taxed income, but for this overview, not so much. You take that number and then you push it through the sausage machine that is Section 901 and 904, meaning you get the lower of actual tax paid versus U.S. income tax liability. And you take the lower of those two. And so here's where you have I've just done the complete little slice of Schedule A so you can see how the total income in line 17 is the number against which you're going to be doing this lower of actual versus U.S. tax liability calculation. And here on Schedule B Part 2 is where you can see in lines, let's say, 6 through 14 is where you end up doing all the calculations, and this applies the Section 904 limitation. So line 6 is the $3,000 that Section 901 tells you you're allowed to take as a credit, and then line 10 is the Section 904 limitation and blah, 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 blah. Down at the bottom, this is your tax credit line 14. Take it over to Form 1120, Schedule J. So this is, it's kind of fun for me in a nerd-like way when I start to see the implementation of specific code sections on specific lines. I don't know why I take joy in that, but I do. One thing I want to just point out, I don't have anything on this slide, but for the tax nerds among you, the high tax kickout, remember I assumed a 30% tax rate. Well, that's a high tax kickout. High tax kickout is another sub-bucketing of passive income that is done to prevent taxpayers from using and abusing foreign tax credit for their own purposes. So you think about two sources of passive income that is received by a U.S. taxpayer, one with a tax rate of 0 and another one with 30%. The government doesn't want you to be using the tax credit, too much of that tax credit on the highly taxed stuff and using the excess amount on against the passive income on which 0 foreign tax was imposed. And that's why they have this separate little barrier. It's just more bucketing of the same way we've done. But in the interest of keeping it simple, but I just wanted to say it here so you don't think I'm an idiot. Well, I'm halfway an idiot, but not a complete idiot. So we are here at the conclusion. And that is a very simple explanation of Section 960 and how the major pieces of it work for the deemed paid foreign tax credit. Remember, domestic corporations and individuals who make Section 962 people, those are the ones that will make this claim. If you are a mere human U.S. shareholder of a CFC, you cannot take this. And this may mean that when we talk about reorganizations and restructurings, you might want to do something like that in order to take advantage of the Section 960 deemed paid tax credit. We'll talk about that in the next upcoming months. So with that, let's take a little break and then we will recoup at 1 o'clock for the Q&A. Thanks for being here. Just as a reminder, December we are skipping because it's Christmas. January we'll come back and it'll be restructuring, reorganization, and liquidation of a CFC. If you have particular brain damage about transactions that you're wrestling with, send me an email and I'll see if I can work it into the hour we do in January. You know, my friend has a problem. My friend's problem is this. What should my friend do? Send it to me. If you're not on the mailing list, go to hodgen.com, sign up. You must be because you got the notice and you're signed up for here. And if you like it, tell your friends and have them sign up too.